We often hear about hedge funds, these titans of the financial world, and the almost mythical edge they possess. It's a perception built on whispers of proprietary algorithms, secret data sources, and a level of market insight that seems to elude the everyday investor. This mystique is potent, conjuring images of sophisticated quants in hushed rooms, effortlessly outmaneuvering the market. But what if this perception, while understandable, obscures a more fundamental truth? What if the edge isn't about arcane secrets, but about the disciplined, rigorous application of understandable principles? The real challenge for many ambitious investors, for those of us striving for true financial mastery, is bridging that gap. We feel the frustration of not knowing how to translate complex theories into actionable strategies, of being overwhelmed by conflicting market information, and of fearing costly mistakes due to a lack of deep understanding. We seek to build sustainable wealth, not through luck or speculation, but through informed, data-driven decisions. We crave clarity, a clear path beyond the noise. Our mission here is to lift the veil. We aim to dissect the core quantitative methodologies that truly provide an edge, not by revealing proprietary code, but by illuminating the logical framework, the data requirements, and the statistical rigor that underpins these strategies. We want to demystify what has been presented as an impenetrable black box. As Warren Buffett wisely put it, price is what you pay, value is what you get. We will explore how quantitative strategies systematically seek to identify discrepancies between price and intrinsic value, a pursuit not unlike a value investor's deep dive, but one executed through a precise, data-driven lens. Over the next few minutes, we will begin to unpack 6 key quantitative pillars. We will reveal the underlying logic, understand the data that fuels them, and grasp the conceptual framework that makes them not only understandable, but, in many ways, adaptable for the strategic investor. This is about transforming perception into practical intelligence, about moving beyond the allure of secrets to the power of informed application. This is our journey into the heart of quantitative strategy. Let's begin by deconstructing the first pillar of this quantitative edge, factor investing. For too long, we've been told that beating the market is akin to predicting the unpredictable, a game of chance. But what if the market's movements aren't entirely random? What if there are persistent, identifiable drivers of return that can be systematically captured? This is the core premise of factor investing. It's about moving beyond simply betting on the broad market, the general beta, and instead systematically investing in elements that historical data suggests have consistently delivered outperformance. Think of it as understanding the fundamental flavor profiles of investing before trying to craft a complex dish. We'll explore what are often called the big 6 factors: value, size, momentum, quality, low volatility, and dividend yield. How do these factors reveal themselves in the cold, hard data? What economic rationales or deeply ingrained behavioral biases might explain why they've persisted through different market cycles? This persistent presence challenges the purist's view of market randomness, suggesting that opportunities for systematic exploitation exist. It's crucial to distinguish between chasing fleeting, trendy factors and understanding those that possess enduring power. For the individual investor, this isn't about building a complex black box. It's about understanding how to tilt your portfolio. Accessing factor-based exchange-traded funds, or ETFs, is one way. Another is constructing a simple portfolio that emphasizes these factors. The key is data-driven selection and disciplined rebalancing, not market timing. Hedge funds, of course, employ these factor models with far greater sophistication, often using leverage and complex multi-factor strategies. But the fundamental lesson for us remains: understand the *y* behind factor performance. This is where the true edge begins to reveal itself. Let's shift our focus to another quantitative strategy that often fuels the hedge fund mystique: statistical arbitrage. Imagine the market as a grand orchestra playing a complex symphony. Most of the time, the instruments move in harmony, their prices reflecting a shared rhythm. Statistical arbitrage, or stat-arb, seeks to identify those fleeting moments when a single instrument or a small group of instruments plays a slightly different note, a tiny, temporary discrepancy. It's about finding micro-disharmony in the market's symphony. At its heart, stat-arb relies on concepts like cointegration and mean reversion. Cointegration means that 2 or more assets, perhaps 2 stocks in the same industry, have historically moved together. When their prices temporarily diverge, the expectation is that they will revert back to their historical relationship, like the predictable swing of a pendulum. The strategy is to bet on this convergence, profiting from the tiny gap that emerges. However, this is far from free money. The risk of misinterpreting these divergences is significant. A fundamental shift in one of the assets could break the historical relationship, turning a potential profit into a loss. The need for extreme speed in transactions to capture these minuscule price differences before they vanish is paramount. This is where hedge funds deploy immense computational power and sophisticated algorithms for high-frequency low-frequency trading, profiting from tiny gains repeated millions of times, while direct, high-frequency start arb is largely inaccessible to the individual investor. The underlying principle of mean reversion is invaluable. Understanding this logic helps us identify assets that might be temporarily overextended or appreciate why certain asset classes might exhibit this behavior. The lesson is clear. The market, even in the short term, is not always perfectly rational. Patterns exist, and while scale and speed are the hedge fund's advantage, understanding the logic of temporary mispricings is an edge for us all. Let's delve into the third quantitative strategy, event-driven investing. While markets often seem to operate on broad economic tides, significant, predictable price movements can occur around specific corporate events. Think of mergers, acquisitions, bankruptcies, spin-offs, or even the anticipation of earnings announcements. Event-driven strategies aim to capitalize on these predictable ripples, anticipating the market's reaction to known catalysts. A prime example is merger arbitrage. When one company announces its intention to acquire another, there's typically a spread between the target company's current stock price and the price offered in the deal. If the merger is expected to complete, this spread represents a potential profit. It's akin to betting on the predictable trajectory of a ball after it's been struck, knowing where it's likely to land. The strategy involves assessing the probability of the deal's successful completion. However, the path of corporate events is rarely smooth. Deals can fail due to regulatory hurdles, shareholder dissent, or unforeseen macroeconomic shifts. The risk of uncertainty is ever present. This highlights the critical importance of deep due diligence, looking beyond the headline announcement to the underlying mechanics and potential pitfalls. For the individual investor, while direct merger arbitrage might be complex, the principle of understanding corporate catalysts is accessible. By closely following corporate news and understanding the mechanics of these events, one can identify potential opportunities. Analyzing the risk and reward of investing in companies undergoing significant corporate actions can be a powerful, data-informed approach. Hedge funds, with their dedicated teams, delve into deal structures, legal frameworks, and market sentiment, taking significant positions and expertly hedging other risks. The lesson for us is that a solid grasp of corporate finance and the catalysts that move markets can unlock specific, profitable investment opportunities, provided the analysis is deep and rigorous. We now enter the evolving frontier of quantitative finance, machine learning, and artificial intelligence. Traditional quantitative models often rely on linear relationships and established statistical methods, but machine learning, or ML, and artificial intelligence, AI, represent a seismic shift. They are moving beyond these constraints to identify complex, non-linear patterns hidden within truly vast datasets, including sources of information previously untapped by finance. Imagine a detective piecing together countless disparate clues, satellite imagery of shipping inventories, the sentiment from millions of social media posts, patterns in credit card transactions, or the subtle nuances of news sentiment. ML algorithms excel at this, detecting subtle correlations that can predict market movements or a company's future performance, patterns that a single human analyst or even simpler quantitative models might completely miss. This ability to process and interconnect diverse data streams is a profound new tool. However, this power comes with its own set of challenges, often referred to as the black box problem. The complexity of these ML models can make their inner workings opaque, making interpretation difficult. Furthermore, their effectiveness is critically dependent on the quality, relevance, and often proprietary nature of the data they are fed. There's also the inherent risk of overfitting, where a model becomes so attuned to historical noise that it fails to predict future movements. For the individual investor, direct application of sophisticated AI is challenging, yet we can leverage AI-light approaches. This involves utilizing AI-powered research tools, sentiment analysis platforms, or insights derived from curated alternative data. The key is to understand the outputs of these technologies without necessarily needing to build the models ourselves, and crucially, to always cross-reference these insights with fundamental analysis. Hedge funds are investing heavily in AI infrastructure and data, building adaptive predictive models. The lesson for us is clear. The future of quantitative investing is increasingly data-driven and technologically advanced, demanding a commitment to continuous learning and adaptation. We've explored several sophisticated strategies, but none are truly effective without a robust foundation. Risk management. For quantitative funds, managing risk isn't merely an operational detail. It's a core strategic component. The ultimate aim is not just profit, but profit achieved with controlled volatility and minimal drawdowns. It's about ensuring survival and consistent compounding over the long term. This involves a suite of key techniques. Position sizing dictates how much capital is allocated to any single trade, preventing a catastrophic loss from a single bad bet. Stop losses act as predefined exit points, positions, cutting losses short when a trade moves against us. Diversification extends beyond just assets. It means spreading capital across different, uncorrelated strategies. Hedging, often using derivatives, provides a safety net to offset potential losses. Think of it like a tightrope walker meticulously using a balancing pole to maintain stability, not just to reach the other side. The behavioral trap for individual investors is significant here. Driven by greed, we might hold winning positions too long, or by fear, we might sell losing positions prematurely. The illusion of safety in simple diversification can be shattered when assets, expected to move independently, suddenly move in unison during a crisis. For us, practical risk controls are paramount. This means establishing a personal risk budget, defining the maximum acceptable loss for any single trade or holding, utilizing trailing stop losses that adjust with market movements, and truly understanding portfolio correlation are vital. Every investment thesis needs a plan B. Hedge funds employ sophisticated value at risk, or VAR, models, rigorous stress testing, and real-time risk monitoring. The enduring lesson is that a solid risk management framework is the bedrock upon which all profitable quantitative strategies are built, ensuring not just success, but longevity. We've journeyed through the sophisticated landscape of quantitative finance, deconstructing the very edges that give hedge funds their perceived advantage. We've examined factor investing, seeking systematic returns beyond market beta. We've delved into statistical arbitrage, finding those fleeting micro-discrepancies in the market's symphony. We've explored event-driven strategies, capitalizing on corporate catalysts, and touched upon the evolving frontier of machine learning and AI in predictive analytics. Crucially, we underscored that none of this is possible without the bedrock of robust risk management, the art of capital preservation. The universal truth emerging from this exploration is profound. These strategies are not arcane magic, nor are they exclusive secrets. They are, at their core, systematic, data-driven approaches. They are rooted in logic, statistical principles, and a disciplined pursuit of opportunities while rigorously managing risk. They are not about predicting the unpredictable, but about understanding and exploiting quantifiable patterns. While direct replication of every hedge fund strategy might be beyond the reach of the individual investor due to scale, speed, or access to proprietary data, understanding the underlying logic and principles is genuinely transformative. This understanding empowers you to refine your own investment process, to make more informed, data-driven decisions, and to construct a more resilient portfolio. As Benjamin Graham, the father of value investing, wisely stated, the investor's chief problem is never the market itself, but rather his own emotions and reactions. Applying quantitative principles helps to systematize decision-making, thereby reducing the interference of emotional biases that so often derail even the best intentions. Your next step is not to replicate, but to integrate. Perhaps focus on incorporating a simple factor tilt into your portfolio, or perhaps implementing a stricter, more disciplined risk management approach for every investment you make. Continuous learning, coupled with unwavering data-driven discipline, represents the truest path to building sustainable wealth in today's complex and dynamic markets. The edge, it turns out, is not in owning a black box, but in understanding the principles that power it.